How do I use ChatGPT to pick stocks better than a fund manager? Well, let me tell you 3 ways, and I'm cheating a little bit here. I'm cheating, and I've written down a little bit of data to share with you. And the first bit of data I want to give you is this. According to Morningstar, 87% of fund managers underperformed the market over a 10-year period. So obviously, it's pretty easy to beat fund managers. And that's because they pick from a narrow pool of stocks, because they've been given, say, the UK brief or the US brief or the AI stock brief or just value stocks. Whereas, of course, if you're unlimited, as I asked ChatGPT to be, it's a lot easier. So here are the 3 ways, and I want you to save this video for later, like and follow as well while you're at it. First of all, right, first thing I do is I upload a bunch of data on Excel for the company's cash flow, P&L, balance sheet. As well as all that data, I get ChatGPT to calculate the ratios such as Sortino, cash return on capital invested, PEG ratios, debt ratios, volatility, Sortino's offers, all the kind of technical and non-technical stuff that I need. Do this across 10,000 companies across London Stock Exchange, European exchanges, and on the New York Stock Exchange and NASDAQ, as well as foreign companies listed in the US. So that gives you about 10,000 companies. It gives you also 6,000 exchange traded funds. They're separate. I'll keep that separate for a moment. Okay. Then, to double check my homework, I ask it to rank stocks with the highest cash return on capital invested, low volatility, high Sortinos, improving cash flows, good revenue growths, and the like, and then weigh those factors independently for me based on the latest academic research on what is important and what are the factors moving the markets. Momentum has turned out to be far more important in recent years than valuation, which historically had been the most important factor for moving stock prices. Growth is, of course, right up there as well, but momentum, as some of you will have worked out, has been incredibly important. Also, a surprising finding compared to historical results has been the larger capitalization companies, the bigger companies, have been doing better with greater momentum than small caps, which were undervalued, which weren't the traditional winners in the 60s and 70s. So the old way of doing things, which your wealth managers, IFAs are probably locked into, no longer work. The second thing is I then ask it, number 2, therefore, rank them instantly. I flag the undervalued companies, but also the ones which are also growing their revenues as well. And then in order to determine whether the market has priced that in or not, I look at ways of examining their short and medium-term prices to see if they've overshot or undershot their historic returns in terms of their average prices. So what I'm looking for here is some kind of mean reversion to their longer-term average prices as well. Some of you familiar with how I do this will know what I do. Then I apply my exit strategy rules again using